All right, well, we've all been there, and if you haven't been there, you're going to be there. A kid's going off to college, he gets socked with a $10,000 bill. The AC goes out in the middle of the summer. Your car breaks down just when you need it the most. Huge expenses that pop up in life, and how you pay for them can make or break your financial future. Financial advisor Matt Deaton is here from Acute Financial, and he and his partner, who's not here today, but
right.
You know what? They do a radio show on Saturdays, every Saturday on KFY at noon, so you can also get some of your questions answered then. So
yeah, we sit there and chitter chatter for an hour, so if you get enough of us there, you can always get us here. So it's, we're trying to get the word out.
Good. I appreciate that, because this is something that happens all the time as we get older. Matt, something comes up. We see this money just sitting there. We think doing nothing.
Right.
Like, why not use it?
Right, and that's honestly one of the common questions that we get. They feel like someone comes in, they have money in their savings, it's there for an emergency, and they feel like, it needs to grow.
Okay.
And what we try to teach people is it's actually serving a purpose. If you didn't have that money, you wouldn't be able to grow your other money and invest it for long-term needs.
Okay.
And so when the AC goes out or something comes out, you have access to funds. You don't have to take it from the retirement account or some of the other savings that you're trying to grow for later on down the road.
Okay, so you say, look at it as three buckets, is the way you gave me a great analogy. The first bucket is that emergency savings fund.
Yep.
Gotta have that,
and again,
right?
it doesn't need to be growing. It's just there for the emergency.
Right, don't worry about it. What's
Right.
a good amount that we should keep in there?
We try to tell people 3 to 6 months, but everybody's different. Some
Okay.
people don't feel comfortable unless they have a year.
Oh.
Because they're approaching retirement or they're in retirement. So
Okay.
it just depends on the individual, but at least 3 to 6 months.
Okay, what's the second bucket?
Well, that's where you're putting money that is still growing, but it has no risk. Because the
Okay.
number one thing that we try to caution and teach our clients is never take money from a bucket that has suffered a loss. So if you're in retirement, you're now taking funds from your accounts, the last thing you want to do is take from an account that just dropped because the market went down.
Well, because you think, oh, well, it's not making any money anyway, I might as well pull it out. Well,
Right, or you need it.
Or you need
you're
it.
Just, you're trying to
Right.
live.
Yeah,
and so
it's not
right.
making money, so
Right.
I'll take it out.
Right.
What's the repercussion of doing that?
Well, again, once you take money out, if it's suffered a loss, you have to have that much greater return just to recover that.
Wow. Oh, yeah.
So that's a big deal. And then when it comes to taking money from a retirement account, especially if you're taking a big chunk, there's potentially penalties if you're not old enough. And then there's taxes. And tax is the big killer, because any money you take out of those accounts gets added to your other income, and that generally will put you into a higher tax bracket, and then everything is taxed more.
And I think a lot of people forget about that you think, okay, well, I'm willing to pay the penalty, but then you forget it's already been tax deferred.
Right. And I was talking to a client and kind of explaining this, and I was telling him, okay, do not take money out of an account that is just lost. And he's sitting there going, well, I can't do, all of my money is invested in the market. So if it goes down, all of it's going down.
Right.
And that's when we started talking about that bucket approach and kind of explaining how every dollar needs to have a purpose.
Yeah.
And some is going to be for emergencies, some is going to be at no risk and growing, and some is going to have some risk. And depending on what's happening in the market, you'll be able to take from one of those.
And that's what you do, Matt, honestly, when people come and sit in your office, and you really take it, you start with bucket number one, and you kind of guide people through this process of
Absolutely.
being prepared.
And try to educate and teach, because again, people are looking to us for advice, but we feel like we need to be a teacher and actually help them understand why they're doing what they're doing, and then lay out the plan.
But at the same time, I'm coming to you because I want to make money.
Sure.
Are you gonna help
the
me do
purpose is to
that?
grow it. But again, when it comes closer to retirement, the number one goal is to protect.
Okay.
Second is to grow it. Again,
Oh.
you need to preserve that money, because the last thing you want is a market downturn to wipe out 20, 30, 40% of your hard-earned money.
Right.
And now you think you may have to go back to work or continue to work when you were planning on retiring.
Okay, that's my walk away. Number one, protect. Number two, grow.
That's right.
Got it. Okay, Matt, good stuff. Okay, let me tell you about actually a special offer from Acute Financial. It's a book giveaway. When you book a retirement consultation with Matt and Damon, and you do that in the next 15 minutes, when you do that, you come in the door, they're going to give you a free copy of 5 retirement myths, which I'd like to go over some other time in another segment, Matt. Here's how you do that. You call right now at 480-620-6907. And here is some more information on Acute Financial. Both of them have locations across the valley and willing to sit down with you at any time, as a matter of fact. Acute Financial, 480-620-6907. And learn more off their website, acutefinancial.org.